Okay, hi everybody. This is Jim, the option professor. Quick background on myself for those who are not familiar with me. I'm a graduate of Boston College. I've been doing the option for many decades, and I've conducted seminars educating people for many decades. So that's thousands and thousands of option traders. So I do know the product of options, and I'm going to share my knowledge and opinions with you today. Of course, I do not give any advice, but I can share my views and my opinions, which is what I'm going to do. Now, you guys are probably well aware that the market had a big reversal and tanked today. So, if you'd like, again, if you have some stocks you want me to look at, you can put them up in the bar. But I have been explaining to people that the first few weeks here of November were going to be dodgy. And so, having minimal positions on or definitely some type of a hedge on would make a lot of sense. And so far, that has exactly been the case. And the main culprits are the ones that had the biggest run ups, which I'll show you in a minute. Maybe some of them you're familiar with, maybe some of them you're not. But let me just give you a couple. And these are all good companies. It's just their valuations are very high. And so people are airing them out to the downside. And this is one of them here. It's something that we did very well with. If you look at the last month, this thing went way up here to 135. Let me put the 1 year up there. So it should give me, that's not giving me very good data though. Anyway, it went way up to 135 and now it's coming down big time. Again, simply becomes of valuations. Another one that had been going really well, a lot of them, Micron Technology, you know, obviously this was a great deal to be in. We were talking about this in the alert all the way down here at 120. So obviously it was a fantastic idea down here. But again, at some point they're rolling it over. Now, as Michael Burry is running around the street and he is, doing Chicken Little on everybody, and he has a story to tell. And basically, the story is that these companies are extending their depreciation from 2 to 3 years to 5 to 6, which is, in his view, not giving us the clear picture on depreciation of these chips and the investments that they're making in them. Also, he is saying that physical utilization is not the same as having any value, and he compared it to having old planes, meaning you could still use the planes, but you don't make much money on them. And so basically, he's thinking that that's how these chips might turn out. And then, of course, he thinks that there's a lot of circular financing where these guys are actually financing their customers. And then I thought it was very odd that in October, all of a sudden, Oracle and these companies are starting to issue debt. The whole big thing was they had so much free cash flow they didn't know what to do with, and so we could invest in this thing, and if it doesn't work, it doesn't matter because we got enormous free cash flow. Well, something happened where they all decided issuing debt was a better way to go. And I think that shook the confidence of people that they went from internal financing to external financing. So there's been a whole bunch of reasons why it's coming down. Clearly, it's a reversion to the mean trade. If you want to know what I'm talking about there, all you got to do is put out the SPX. I'll just show you three reasons why I thought this thing obviously had some trouble. This is coming down to the first reversion was around 60, 67.50 or something. And then the next reversion could come down here as low as 64.60, which is obviously not very far from where it is now. So once it couldn't, and everyone thought it was going to be like October. You see October, it peaked through a couple times, and then all of a sudden, right back on the bicycle. Well, this time it peaked through and kept going through. So it's a lot more severe this month. And the thing that told you it was going to be a little bit more severe, and it's something I brought up in my news alert every Sunday night, is the VIX. And the VIX has been pretty clear. Like I say, once we had that big spike in April on the VIX, it was kind of, behaving. And so big money and institutionals and family offices that got kicked out during the April drop, they all came back in, not all the way in, but they certainly started coming in. And although we had one spike up here in October, it didn't last, only like a day. And then we had another spike up here, and I don't know how long it's going to last, but it may last longer than a day. The main thing I was trying to tell people is that when we had this spike up, the blue line on this, the trend was still coming down. So then when it came back under, everyone got their confidence back because it looked like that was a one-day only affair. We don't exactly have that now, do we? We've got a rising VIX with moving averages rising as well, which might be indicating this is not a one-day only sale. I know guys like Tom Lee on CNBC. You could throw a Mack truck at the guy, but he's definitely sticking to his guns. That this is a temporary pullback, and we're going to go up and make new highs on Bitcoin and new highs on the S&P, and happy days are here again. Of course, I would love to see that happen, but I'd like to see some evidence that it's happening rather than just step in front of a Mack truck hoping that they run out of gas. Because right now, that's what's happening to people that bought these tech stocks at high prices, and then, of course, saw them back off. Which again, we had these on the alerts a long time ago, so these are not strange names to us. SDNK, SanDisk. That was a fabulous idea that we brought in the newsletter at a very low price. But just to give you an idea on SanDisk, SNDK is the symbol, I believe. And then you can see that the darn thing, come on. I mean, this was a fabulous deal the last 90 days. Okay. But I mean, this is extended, man, and it's having a reversion to the mean. So now that it's down to the blue line, don't throw it out with the bathwater. Start thinking if this thing is a real legitimate company, maybe there's something to do down here. You know, I'll bet you Teradyne's probably getting whacked. And this is another company, it's coming back down to where it might, fill this gap and have support here. So somewhere in this 150 neighborhood might not be a terrible thing to see if it's going to stop. Because if it doesn't, we're probably going down to 6,000 on the S&P or lower, and you're going to probably pick this thing up for 120 bucks as it fills this gap. But these are companies that have something going on, and I don't know that a pullback here, that is shaking out the dust is really going to change their long-term prospects. So what it is changing is their valuations and their stock price, which in many cases, this is why this guy Burry was shorting this thing 85 times sales. 85 times sales is big. It's off the charts. Price to sales, So, where's this thing going? Well, it's going to try to stop here. But if it can't stop here, again, you can see coming down here. Now, this Burry's got $50 puts, which means he's looking for the entire business to stall out. And he's looking for things to happen that, he's looking for it to come back to 50. Or listen, it doesn't have to come back to 50. If you're out in July or whatever he is on 2027 and it has a 200-point drop, those puts are going to scream and he can get out of them at any point. So just because he's in the 50 doesn't mean he has to wait for 50. Again, I'm sure they're already kicking butt from 200 down to one here. I'm sure he's already getting a lot of juice on those puts because they've got a lot of time on the clock. And though they're way out of the money, the momentum and the implied volatility on the downside is definitely screaming. So I'm sure he's getting nothing. Just to give you an idea, and then we'll go into some of your stocks. If you go out to that 2027, I don't know what day he's in out there, but let's just say he went to the June ones, just to use that as an example. And then if you got to put up all strikes because obviously they're so far out of the money. And then if I go down to the $50 puts, I see 473. So I've seen those things trading as low as like $3. So they're not moving that much. But like I say, if you drop another $100, it's very possible that they would be going for $38. So, or if you drop another $50, it's very possible they could be going for $15. So anyway, you look at it, if there is a further sharp drop in the stock, they will start reacting even though they are in left field as far as the strike price is concerned. So according to how much time goes by. And of course, how the momentum, what is the speed of the market? So we'll have to keep an eye on that. But I just wanted to give you an idea of what he's thinking is happening. And what he's thinking is happening is the whole thing is going to unravel. And, stranger things have happened, right? I mean, do you have high prices on stuff? You do. Have they already had huge run-ups? They have. Have people maybe extended how quickly it's going to be productive to people? They probably have. Is it going to take a little longer to actually make a lot of ROI on it? It probably will. So that's why it's having a pullback, and that's why if we were to go from a pullback in this stuff to a cancellation, then obviously all bets are off because these stocks are not prepared to hear that the AI revolution is not producing gains. The people are going to stop spending money on it for a while. They're not ready for that at all. Okay, so let's see here if you got some stocks here. Let me write them down. We got GPI, RIGL, and we've got, of course, NVIDIA. Well, guys, one thing about NVIDIA, that I thought as soon as it opened up. I thought it should be up 20 bucks if it was really a great report. I didn't think it should open 10 bucks up or something like that. So I'll start with Nvidia so I can show you exactly what I was saying here. Because we had a high of 211, right? So we have a high of 211, and the thing has gone down from to 175 or 185 or whatever. So it goes into the 190s on supposedly the best report you've ever seen and the best forecast you've ever seen. And you're still what? You're 15 bucks underneath the high, So I mean, that was a cause of concern to me. There it is right there. You see, you have the high point up here at 210, a little bit higher, and you drop down here. And so they had the greatest report of all time, and it pops up. But like I say, I thought it should have popped up and filled that gap. That's what I was looking for. I was looking for something like, fill that gap at least up around 208. So the fact that today it went up here, and then if you look at the 30-minute graph, you can see there was just a spike up, cover all the shorts, uh, get all the people who had buy stops above, just basically blow out anybody who was negative, and then take it right back down again. And of course, I always wonder, okay, who was selling up here on all that great news? Who was buying puts when everyone was selling puts up here? Who was selling calls when everyone was buying calls up here? What did they know that nobody else knew? Because obviously, probably market makers were the guys doing it. And market makers obviously are very happy the way this thing is priced out. Because not only has it didn't hold its gains, but now it's underwater. And whether it's going to continue or not, it definitely, doesn't look good because you see all these lines pointing down. That means, and that's, again, when you got everything pointing down here, the likelihood it's going to go up, and if it does go up, sustain a jump is not that great. And that's why I thought failing to fill this gap up at 208 on such fabulous news. I mean, come on. The guy's making all kinds of money and he's got so much business that they can't fulfill it. I mean, that's pretty good stuff. But when I hear they have more business than they can fulfill, I'm thinking Boeing. Boeing's got like 5,000 planes that are on order, but they can't get them done, and that's why Boeing stock languishes quite a bit. So again, having orders that you can't fill, and having orders that are being financed by the people who are giving it to you, maybe that's not so great. So that's the story today. That's the story today. Where would I be interested in NVIDIA? I'd be interested in NVIDIA over these highs here, right? And where the blue line is. So it could stop here. It could stop here somewhere between 175 and 180. It could very well stop here. But if the momentum is really pointing down on it, and again, it's still above 50. So again, I wouldn't throw this out by any means, but where would I be most interested in writing a check for it would be between 175 and 180, a little bit, and then maybe a little bit more if we went down to 156, 155, somewhere in that area. Call it 150 to 155 in that neighborhood. And then, of course, if the wheels totally fall off, then there's your worst case down here at around 115. So that's the story. That's pretty much it. Like I say, the revolution is still going. It's just that they're starting to ask how much the price of the tickets are. The other one we had listed there was GPI. And this is a Group 1 automotive. And this one is obviously you're trying to buy at low prices because it is low prices. What you don't know, unless you look at the long-term graph, is how low are they? And they're low to where they could stop here. So this would be a station to take a break at 376, right? So it stopped there. That's a good place to stop. If I was going to take a shot at it here, I certainly wouldn't want it to break 376. And then if in fact I wanted to play the Price is Right, I might wait until it gets down to 330. And that gives you the longer term perspective, which is sometimes helpful. See, there you go. It could, you see there's a low there plus a thing there. So 360 would be interesting. And 350, what do we say? 350. Although worst case is down there at 330. Okay. All right. Let's take a look here. And on a short-term basis here, again, it's trying to stabilize on the RSI. We've got a low here. It's at 37. We got a low here at 43. So that's not bad. So it is trying to stop going down. There's no doubt about it. That is a good thing. And down here, like I say, at least if it can get above red, which is 389, which it's trying to do, but not doing, then at least you got one of the lines. But again, this is a downtrend, and this is a tough thing to do. Much easier to go with the trend, and much easier to go when it's closer to the averages. Like here, if you want to be shorting it, this is your neighborhood of shorting it. If you're buying it for a bounce, maybe against the gold down here. But here you're kind of in the abyss, and so it's a rougher time to make a decision. RIGL. Okay, pharmacy is getting bids. I mean, this is a sector that's doing good. Today we had Exact Sciences or something like that. EXAS had a great day. A couple of other ones as well. So, this is an area where people are buying into, as you can see. But again, where would this be the best time to have taken a shot? It has a correction, it goes against support, and then you load the wagon once the lines turn up. Then you'd be worried about nothing. Now, what are you going to do up here? In my view, my opinion, I would take my gains on the stock and I'd turn it into a vertical call spread. Then I'd have limited risk up here and I'd still have a position if it's going to keep going. If it goes back in the toilet on me, I lose the vertical call option spread, which would be a heck of a lot less than the profit I'd be giving up from 30 to 48. So the bottom line is all according where you got in and stuff. But this is a hard time to be initiating a position. If you're in there already, it might be time to talk about a little bit of risk management. And that is where you try to maintain a long position, but reducing your cash risk that you have in case the thing dumps. And what would make you think it could dump? Because it just showed you it can dump when it gets way away from its averages at 43. It can come all the way down to 26 and have a reversion to the mean. So obviously that's a risk. And to mitigate that risk, you try to maybe take money off the table and then reinvest some of it into a speculative vertical call where, again, if it keeps going, you're in there. And if you're not, and if it pulls back, you just lose the vertical call. If you look at longer term charts on this thing, again, these things can go wherever they want to go. So, I mean, this thing could be on its way to 50, 60, 70 bucks. Who knows? I do know this, though. When you buy these things after they've had big run-ups, it's dangerous. Has been. Can't tell the future from the past always, right? Past performance, that kind of thing, not indicative. So that's the story on Regal. It's all according to what you're trying to do with it. At the end of the broadcast, if you have any questions, you'll get my contact information so you could talk to me a little bit further about different tactical opinions on what to do with these kind of things when they're at certain prices. And then we had, so those are three there. You got anything else up there for me? I'll give you a little bit more information that might be helpful to you. Tesla and Rivian. Okay, let's go over there. Now, I do very good with Tesla because I only do it when they're on sale. When were they on sale last? I'll show you. They're on sale when they revert to the mean. You see, when they're up here to 500 and people say, I got to get in, I got to get in. I say, no, no, no. It's going to revert to the mean at some point. What is that? Well, it means it's going to go down to the red line at least, or then it's going to go down to green, or it's going to go down to blue, or it's going to go down to purple and gold. Well, it did the full Monty all the way down there. So down here at 240, that's the place you've got to take your shot. Call options are cheap. Prices are cheap. You can go way out in time, give yourself 6 months or so. And then the next thing you know, rather than buying the stock for 240 grand for every 1,000 shares, you could probably buy 10 vertical call spreads for 10 grand. And then basically, if the thing goes up like it has, you can benefit from that advance. So what's going on right now? We got a double top up here. And what does that mean? That means you got 74 on your RSI here. And then on this big rally, the RSI is at 61. That's called a divergence. And that's called it has no legs. That's why it's dropping, because it had no legs. And so now you're looking at a situation where is it going to stop? And again, you see these highs here. And you see the green line all around 360. So that would be a natural. 340 would be the second natural. So 360, 340 would be a nice zone. And then, of course, if it gets back above the red line, which is 417, then that might tell you that it's back on the bicycle. But the most interesting time for me on Tesla is when they have the full drop down towards one of the lines. Like here, beautiful time to take your shot. But even after you take your shot, if the blue lines are pointing down, it's a temporary pop, right? So again, this thing had a nice little oversold down to the gold. It had a pop up, and then it came back down, and then it had a pop, then it comes back down. This was a real washout. This was like washout city. I think this is when he was in the White House talking about it with his hacksaw, with that chainsaw thing. This is probably when that was going on. And then basically, once he left the White House, people got excited again. But this is a very volatile stock. So I would just be patient on it. When it comes back to you, that's when you take a shot. So if this thing came down to 340 or 280, I certainly would find it very interesting. And if we had a major league drop to 6,000 or less on the S&P, then you could see 340, and you might even see even further, because when this thing gives it up, there's a lot of people to come out. And again, a lot of the stuff they do is futuristic, which when futuristic is deemed unrealistic, people dump it, and they dump it in a big way. So the bottom line is if robotics and self-driving everything and going to Mars and everything's going to be, no one's going to have to work in 10 or 20 years, according to what he was in the paper talking about today. If that kind of talk becomes a little far-fetched, then of course that's when you can have some pretty big sell-offs. So again, obviously a great company as far as the futuristic products are concerned. And there's some very, very wealthy people who've made a lot of money with them and who definitely believe them. So again, if you do get it on sale and you want to take a chance, that would be the time that I would think would make most sense. The other one's Rivian. I saw Rivian was doing pretty good for a while recently. Let's see what it looks like. Okay, if you look at the long term on Rivian, it obviously came out as a public stock, and then it just went into the toilet and has been flatlining ever since. These kind of stocks are not that interesting to me because whatever the problem is that makes it go flatline for a long time might not be that easy to resolve. That's my view on this type of a thing. And so basically, if you're looking at the 1 year graph, it gave you all kinds of chances down here at 13 bucks, of course. And then this is when the options are cheap. So that makes them interesting. This is where it's making a turn. That makes it interesting. And having a jump from here to there makes it rewarding, right? So now it pulled back. And if you want to take another bite, this is a neighborhood down here at about 14 and change. And right now it is trading at 1466. So the question is this a pullback? And then it's going to start taking off again? Well, you need to start closing above the red line there, which comes in at 1571. So if you start closing above 1571, the odds that it's had just a pullback and it's going to have another advance would increase dramatically. Otherwise, if it starts going the other way, this is just part of the back and forth on a company that has all kinds of issues that sometimes it looks like they're solving them. And then, of course, it comes back and doesn't look like it's solving them at all. And that's what creates that kind of back and forth activity. But again, when I look at something like this, there's obviously a problem with the company. And then, is it really getting resolved, or are you just getting mixed reports from time to time that get the traders pushing the stock one way or the other? Oh, it looks like they've solved all their problems and it's up at 17. Oh, I guess they haven't. It's back at 11. No, I think they have. It's at 18. No, they haven't. It's back at 12. Now, of course, they definitely look like they did good. And then we're right back again. So again, this is a classic case of you really got to buy weakness if you're going to. It's like real estate. They say make your money on the way in, meaning get a great purchase price. Don't try to make your money on the way out. Same thing with this. This thing, you got to make your money on the way in because you bought it properly, not buy it just any time you think it looks good, because that can be a problem. And when traders do that, they tend to lose money. One thing I wanted to show you, a couple of other things. I showed you the VIX, right? So you understand that's a very important thing right now. The longer it stays above 18 or 20, the worse it is for this stock market. Believe me. Now, here's another thing that's a problem. This is called the number of stocks above their 50-day moving average. And this don't look so good right now. So it's got to stabilize right here because you can see this is called a rolling over top. And you can see the gold line is the last stand, and underneath that we have the abyss. We have a gap down here. So just imagine if the percentage of stocks above their 200-day average, which is clearly going down, started to accelerate to the downside and fill this gap at 25%, then I would imagine the stock market's going in the toilet in a very big way. So, but you can see it's holding on for dear life right around the 50 number, and it's a little bit under it right now. Let's look at the longer term graph. Yeah, can you see why it's holding on to that number? So this is real important. I think if we can hold this 6,500 neighborhood, or what was that number? 6,460? Well, what's 30 points on the S&P? Nothing. So let's call it 6,450 to 6,550. Let's say we hold that neighborhood and we hold this neighborhood on your percentage stocks above your 200-day. And let's say we hold that VIX under 25 and 22 and it starts migrating under 20. Well, then I think the guys who are thinking about the land of milk and honey in December and January, I think they may have a case. And this could be a deal where it's darkest before dawn. But I need to see a few things happen for that to occur. So, um, yeah. So if you guys have any other stocks, I'm coming to the bottom of the hour here. You can contact me at the address that David is going to be putting up there. And also, um, let me see if I have something else here for you. Well, again, at the Option Professor, we've got three things we got going for you. One is we have an options class. When you get a subscription with us, it's 6 hours and 3 sessions of option learning. It comes right out to you with your receipt, and that's a good deal because it's a $397 value for no cost. And then we have every week, I give you my best ideas on the options and what's going on in the market.